Hello everyone, welcome to the class, welcome to Crack Grade B. So I hope you all are well and leading a good life, and the most important thing is you all are happy. As you see the quote above, there is written, success is not the key to happiness, happiness is the key to success. So if you are happy, you will gain more knowledge out of this lecture and gain more potential of your life also. Always be happy, and with this positive thought we are starting today's lecture, which is based on fund flow statement. So my name is Amol Bhatia, and will take this lecture for 30 minutes. So be with me all the time, don't be distracted from anything. Okay, let us start. So as you see, the topic name is fund flow statement. So two words are involved in this. We have to make statement of fund flow. So we have to record in the statement flow of the fund, right? So we need to know what is the meaning of fund and what is the meaning of flow. So, and then when we know the meaning, then we will learn, but why do we prepare fund flow statement? Okay, so first of all have to know the meaning, and then we will know why we prepare this statement. Okay, so as you see on screen, flow of fund means the inward and outward movement of the fund of an enterprise. So inward and outward movement means, what is the inward movement? If we get from funds from outsiders in our business, so that is inward movement, and if we give our funds to outsiders, that is outward movement. But when we say we give funds and take funds, what does this fund mean in this line? So here it is written, fund means working capital, and flow means movement or changes. So basically we have to record changes in the working capital in this statement, fund flow statement. Okay, clear. But any question now? You must be asking that what is working capital. Okay, now next question comes, what is working capital, because we have to record inward and outward movement of working capital. So moving over to the next slide, this is the meaning of working capital. Working capital means current assets minus current liabilities. Okay, current assets minus current liabilities equal to working capital. So where do you find current assets and current liabilities? We find it in the balance sheet. Current assets on the asset side and current liabilities on the liability side. So what is working capital? So there are two types of capital, fixed capital and working capital. Fixed capital is involved in the business for a long term. Okay, so whoever has financed for the long term in the business, it is the fixed capital of the business, because we have that funds in the business for long term, and as it is fixed for long term, there will be not much changes in those funds regular basis. But working capital is based on current assets and current liabilities. So let us understand the meaning of current assets and current liabilities first, to understand for more deeply working capital. Okay, so moving to the next slide, current assets means any asset which can be reasonably be expected to sold, consumed or exhausted through the normal operations of a business. Okay, sold, consumed or exhausted through the normal operations of the business. So current asset means any asset which can be sold. What do you mean by sold? We sell an asset. Okay, like we have a building, we sell it. Okay, so is it a current asset? If we sell a building, is it a current asset? So consume, we have a building, we consume it in business. Okay, we use it in business, is it a current asset? So that for that we have to understand the rest of the part of the definition, that sold, consumed and exhausted through the normal operation of the business with the current fiscal year or the operating cycle. So it should be sold, consumed or exhausted within the current fiscal year or for operating cycle. So what does it mean? means we have bought that good within the year and sold within the year. Okay, bought and sold within the year. So building is for long term, so it can't be a current assets. Okay, so it can't be current assets because building is generally taken for a long term period for setting up this factory or office. So in current assets we can take stock. Okay, when we purchase stock we have to sell in the it in the year. Okay, or sell it in the year, or we can convert it easily into the cash. So what is written here is current fiscal year or operating cycle. We near what is the current fiscal year? Like we prepare our profit and loss account for April to March. So this is the current fiscal year. So we can take this assets on the basis of this, that we consume it, sell it, or they get exhausted within the year, fiscal year, or operating cycle. So we need to learn about operating cycle now. What is operating cycle? Operating cycle means like we purchase the good first. Okay, then we manufacture it, then we market our goods. Okay, so then we sell it. So it sometimes it in some business it involves a lot of time, more than a year, but it is in their operating cycle. Okay, for the operation and in the operating cycle, so it will be considered in current assets even if it is more than year to consume that goods. So it is written here whichever period is longer. So any asset which can be sold, consumed, or exhausted within a year, or operating cycle, whichever period is longer, is current assets. Okay, so we get to know about this definition. We move towards the current liabilities. What is current liabilities? Any short-term financial obligation. See, any short term, not for long term. We are not about loans, and we have to ignore loans and all everything, because that like I take a 20-year loan, and we take generally more than a year for a loan. Okay, but we are here talking about the short term liabilities, like creditors. We purchase goods from creditors, and we have to pay them within the year or within the operating cycle. So as we see on the screen, it is all that written in here. Any short-term financial obligation that are due within the current fiscal year, or which within a normal operating cycle, whichever period is longer. Okay, so same definition as assets, and there is in assets there is assets which can be sold, consumed, or exhausted. In current liabilities is short-term financial obligation, but same fiscal, it should be within the fiscal year or normal operating cycle. And you know what is the fiscal year and the normal operating cycle, and whichever is the longer, it will be considered current assets and current liabilities. So why did we study it took so much time to we take so much time to study current assets and current liability? So moving towards the previous slide, what we learned in there, that fund flow statement is the recording of working capital, and working capital is current assets minus current liabilities. So that's why we are learning about current assets and current liabilities here. So current assets within 12 years, within 12 months, which is fiscal year or operating cycle, or current liabilities, financial obligation to be paid, okay, within fiscal year or normal operating cycle. So I hope this is clear. So moving to the next slide, we will learn more. Yes, so now we're gonna learn about the effect of current assets and current liabilities on the fund flow statement. So what it means, current effect of current assets and current liabilities on the working capital, right? So there is a direct relationship in current within current assets and current working capital. So and inverse relationship in current liabilities and working capital. What does direct relationship means increase in current assets leads to increase in working capital, and decrease in current assets means decrease in working capital. Okay, and likewise it is inverse relationship in current liabilities and working capital. So increase in current liabilities leads to decrease in working capital, and decrease in current liabilities leads to increase in working capital. So so we know there is a direct relationship in current assets and working capital, and inverse relationship in current liabilities and working capital. Let us understand it from this formula also. Like we have working capital equal to current assets minus current liabilities. If we apply mathematical condition also in this, uh, we have addition, current assets in addition and current liabilities in subtraction. So whenever we subtract anything, it leads to reduction in amount. Okay, so obviously current liabilities is in inverse relationship with the current working capital, and current assets is in addition, so it will lead to addition in the amount of working capital, so it is in direct relationship. Okay, I can explain you with it with the example also. Like we have current assets of 1 lakh rupees and 50,000 current liabilities, so working capital equal to 1 lakh minus 50,000 equal to 50,000 equal to working capital. Okay, so our working capital is 50,000. So likewise, if we increase current liabilities 50,000 to 70,000, so 1 lakh minus 70,000 equal to 30,000. So working capital has decreased. Okay, current liability increased, so working capital is decreased. If we increase our current assets 1 lakh to 1 lakh 20,000, okay, 1 lakh 20,000 minus 50,000, 70,000. So working capital increase when current assets increase, and working capital decrease when current liabilities increase. So hope this is clear. So now let us do some analysis and learn about current assets and current liabilities from the balance sheet also. So we see on the there is equity and liability side on in the balance sheet, and there is asset side on the right side in the balance sheet. So in equity and liability side, there is equity capital, profit and loss, non-current liabilities, current liabilities, and on the asset side, there is non-current assets and current assets. So we see capital. What is capital? That the owner has invested. Okay, profit, whatever we have earned during the year or in previous year also, it get into the profit and loss reserves here. In non-current liabilities, what we have, that liabilities which are not current liabilities, like we have already studied current liabilities. Whatever is not current liabilities, non-current liability. Okay, so in simple language, it will be not settled in within the year, fiscal year, or in the operating cycle. And current liabilities you already know. Non-current assets is similar as non-current asset is not, which is not a current asset. So current assets you already know. So in if we want to show working capital in the balance sheet, how we will show? Current assets minus current liability. You see 3,55,000 current assets and current liabilities are 55,000. So if we want to show working capital in the balance sheet, what we have to do? 3,50,000, 55,000 minus 55,000, which is 3 lakh. See, balance sheet total is tallied 8,40,000, 8,40,000, 7,85,000, 7,84,000. So it does not make any difference in the balance sheet, and it is just the way of analysis of the balance sheet. Okay, um we need to know that how can a working capital or current assets and current liabilities can change. So it can change due to non-current assets also. How? Current assets can change due to non-current assets also. How? Build, if we took an example that we sold a building. Okay, when we sell a building, then we get money, and money, cash, is a current asset. So there is a relation between non-current and current assets. So there is, if there is change in non-current assets, there can be change in current assets also. Likewise, current assets and current liabilities are also related. We can, if we take loan from outside, they can be increase in cash, so they can be relation between them also. Equity capital, same, we can get cash if equity capital is issue. And profit and loss, and like we earn revenue, so we get cash. Okay, so current assets is involved everywhere, current liabilities and current assets. Like if we purchase, we increase our current creditors. So if we want to make the deep understanding of the working capital, we also need to understand the relationship of current assets and current liabilities with all of these. So if current assets and the current liabilities are increase or decrease, or working capital is increase or decrease, there must be double entry effect in anything else. Okay, so we need to correctly understand whether it is in non-current asset, equity, capital, profit and loss, or non-current liabilities, and accordingly we have to solve or understand the complications in the topic. So moving to the next slide, here is format of fund flow statement. We see here that there is source on the left side and application on the right side. So there will be one source from where the fund will get inflow in the business, and there will be application of funds where it will get reduced from the business and we will pay it outside the business. So where what can be the sources? And so first we will learn about the sources. So first of all, it can come from the funds from the business operation, like we earn revenue in from business operations. Okay, we are operating for in the business for like we sell the goods and other operating income. So we get funds from the business operation. Then like we studied about the in the balance sheet, there is equity capital. So if we issue additional equity capital, we will get funds. So it will be source of funds. Okay, so it will be get added in the source of funds side. Okay, then it comes issue of debentures, it comes under the non-current liabilities, it get added in the sources. Then sale of investment, sale of assets, loan, the non-trading receipts, it is not on the operating cycle and it is non-trading receipts. Okay, and at last there is decrease in working capital. If the current liabilities are more than current asset, there will be decrease in working capital. Okay, if there is decrease in working capital, okay, means current liabilities are more than current assets, means assets are less. So we will apply a fixed capital for that. To compensate that, we have to apply fixed capital. So decrease in working capital, we have it is a source of fund, it is a balancing figure in this format to analyze the working capital. And now coming to the application side, loss of funds due to the operations. Loss of, if we get funds from the business of operation, that comes under sources. If we get loss of funds from due to the operations, it comes under the application. Then redemption of preference shares. Okay, if we issue shares, we get money. If we redeem, we get give back shares. So we apply our money towards the redemption, we give our money. Then redemption of debenture, purchase of investment, purchase of assets, loan days, payment of loan, tax paid, okay, dividend paid, non-trading payments. So you see, like we are getting money from investment, here we are purchasing, we are applying the money. So it is just the opposite. Okay, the additional points are only tax paid and dividend paid. So if we have a capital, we have to pay dividend. If we earn income, we have to pay tax. So it is also an application of. And in last we have increasing in working capital, which is also balancing figure, and we can find it also in next slide. Okay, and we use it for analysis. So hope your format of fund flow statement is clear. And moving over to the next slide now, this is, as you see on the slide, it is determination of fund from operation to adjusted profit and loss account. So as we saw, we have to put here fund from business operation. Okay, so what are fund from business operation and loss of fund due to operation? One will come, either this or either this will come in the fund flow statement, but how will we obtain that? In this slide, we will know how to prepare adjusted profit and loss account. Why do we need an adjusted profit and loss account? Because we have to transfer fund from business operation and loss of funds due to operations here in the fund flow statement. So we get that from here, where it is found in this fund from operations in adjusted P&L here. Fund from operations Okay, here you can see fund from operations, right? So how this is, as you see, this is a balancing figure. So how we obtain this balancing figure, which is to be transferred to the fund flow statement. So starting from the beginning, we have to enter at first here profit and loss account, opening balance of profit and loss, and here we have to write closing balance of profit and loss account. You just forget everything else in this format. Just see this. We have operation funds from operation balancing here, opening here, and closing here. Now understand, we have assume a balance sheet. We have 50,000 rupees in the profit and loss account in the beginning of the balance sheet. Means 50,000 in we are preparing balance sheet of 2019-18 April 2019 to March 2020. Okay, so in April 2019 in the beginning we have 50,000. Okay, in the profit and loss means we have earned 50,000 in the beginning of 2019, and when we see at the end of the 2020 March 2020, we see we have 80,000 in the profit and loss account. Okay, so 50,000 in the beginning, 80,000 in the end. What does it mean? That 30,000 is earned during the year, right? So 30,000 is earned during the year. So what we are doing here, we will enter 50,000 here, right, and 80,000 here, and when we subtract 80,000 minus 30,000, 80,000 minus 50,000, we get 30,000 fund from operation balancing figure here, right? So what we get, that funds which we have earned during the year from the operations, right? Now question come about other items which are written here. So you see in profit and loss account, we enter non-cash items also. Okay, non-cash items also. So there is like depreciation of fixed asset, primarily goodwill, return of discount on issue, transfer to reserve, proposed dividend. This is non-cash and non-operating items. And on the income side, we add non-operating incomes. So to get fund from only operations, we get the balancing figure fund from operations only. We we can we all we have to reduce the effect of these transactions. So in the closing balance, we have reduced the balance, we have reduced the effect of non-cash transactions, whether it be on the debit side, which is expenses, and or it be income. And like whatever it is, like dividend paid, we took dividend paid in the fund flow statement, right, here, and tax paid here only, so we can't take it twice. So we are reducing the effect here in the fund from operations, because we want fund from operations only. So we are taking opening of profit and loss, then closing of balance, closing of profit and loss. If we don't have non-cash items, non-operating items, then easily we can get fund from operations. Like we have only profit and fund from operations in the profit and loss, and non-operating items, we have not put any non-operating items or non-cash items in the P&L, so we can easily get fund from operation. But if we have non-operating income and non-cash items, here it comes for the expenses, and here comes for the income. So if it is income, it will come here, and if it is expense, it will come here. So we have reduced the effect, then we are left only with the fund from operation, and then it will be transferred here, fund from business operation. Like and if there is a loss during the year from business of operation, you will get this balancing figure on the left side. Okay, so from left side you can transfer this from this to here, right? Now coming to the next part is 8 point, which is decrease in share working capital and increase in working capital. So how we found there is statement of changes in working capital, we have to prepare. Okay, so there is it is on your screen, so check current asset. We have to take all current assets from previous year and current year. Then we have to check whether these current assets are increased or decreased. Likewise, we have to take current liabilities and we have to see if it is increased or decreased, and whatever it comes we have to take net working capital. Now you know current assets minus current liabilities, A minus B, current assets minus current liabilities, it will come here, you will get working capital, and when you subtract this you will get net increase in working capital, net increase or decrease in working capital. And if it is increase in working capital, it will come in the right side, and if it is decrease in working capital, it will come in. And it will always tally, format for fund flow statement will always tally. So we have fully analyzed working capital, that it will working capital can change from change in within current assets and current liabilities. It can change from revenue, and we get it from profit and loss adjusted account, that whatever changes in done in the operating cycle or from the revenue. And if it is current assets and current liabilities, we have learned what we get for it from here. And if the other items of the balance sheet, we get it directly here in the fund flow statement. So we see here equity capital, we get it from the fund flow statement directly if any changes is done. And profit and loss, for profit and loss we take it from here, right, from adjusted P&L. And non-current liabilities we directly take in fund flow statement. Non-current liabilities here, loan raised and all. Non-current assets we take directly here, like purchase of assets. And current assets and current liabilities we take here, statement of changes in working capital. So this is complete analysis of the balance sheet in fund flow statement. Okay, we take everything, whatever changes in it may be, it is basically for the analyzing the working capital. And we get to know that non-current assets and everything can lead to change in current assets or current liabilities. So it is a complete analysis. So we need to know the format of these three formats. Okay, so moving over to the MCQs which we have. So on the screen, which statement is prepared in the process of fund flow analysis. Okay, so which statement is prepared in the process of fund flow analysis? Schedule of changes in working capital, fund flow statement. So you know we prepare both of these, changes in working capital also, fund flow statement also, so both B, A and B. Next, moving to the next question, fund flow statement is prepared on the basis of data of P&L statement and two consecutive balance sheets, right? Is it true? We took data from P&L statement, right? And we took two consecutive balance sheet also here, previous year data and current year data. So it is true, the second is true, right? So moving to the next question, which of the following rules is true while preparing of schedule of changes in working capital? Okay, so let us see. Increase in current assets. First of all, what have we learned? Current assets have direct relationship with working capital, and current liabilities have inverse relation with working capital. So as we see here, increase in current asset, increase in working capital, right? Increase in current asset, decrease, no, not right. Increase in current liability, decrease in working capital, right? So the right answer is A and C, and which is A, right? Moving to the next question, if provision for bad debts is mentioned in the question of fund flow statement preparation, it can be shown as. So what is provision for doubtful debts? Provision for doubtful debts means we have doubt that our debtors will be recovered or not. Debtors are the person from whom we have to recover our money. Okay, from whom to whom we have made sale earlier, and now we have to recover money. But we have provision for bad and doubtful debts if we feel that we will not be able to realize money from them. So where should we mention it in fund flow statement? So as we know, provision it is current liabilities, so we can show it separately again in the current liabilities, or we can deduct it from total debtors also under current assets. Okay, we will like we have 1 lakh debtors from which we have to collect money. Okay, 1 lakh rupees we have to collect, and we doubt that we can't collect 20,000. So in net we have to collect 80,000. Okay, if we or we can also show it under current liability that we have doubt of, and we can show it as a provision. So both A and B are correct, so C the correct answer. Now coming to the fifth question, fund flow statement is also known as statement of fund flow, right? Statement of sources and application of funds. Yes, we saw that there is left side sources and right side application. Then statement of sources and uses of funds. So application means uses only, so sources and uses of funds. So all of the above are correct. So moving to the next question, this is some numerical. So let us see. Given net profit for the year 2,50,000 transferred to general reserve. Okay, given net profit is 2,50,000 for the year. Okay, then transfer to general reserve is 40,000. Okay, in net profit we do not include this 40,000. Okay, this is done in profit and loss appropriation account, not in profit and loss account. So when we get net profit, we have only revenue minus losses. So we have net profit here 2,50,000. Okay, and we have to calculate fund from operations. So net profit is 2,50,000. We have taken revenue and expenses here. Now comes old machinery bought for rupees 50,000 was sold for 20,000. Okay, bought for 50,000, sold for 20,000. So here we have 30,000 rupees loss. So 30,000 rupees loss. This loss must, we have we have 30,000 lost, and it must be debited in the net profit, in the profit and loss account. So this 2,50,000 must be reduced by the loss, but it is not the operating loss, so we have to add back it. So 2,50,000 plus 30,000, 2,80,000. So it is a non-operating item, non-operating loss. So we have add back, and we get A is the correct answer, 2,80,000. Right. Now next question, which of the following are sources of funds? Issue of bonus shares. Bonus shares are given to employees or stakeholders for free. So there is not a change, not change in current assets. Okay, we don't get cash or any liabilities credited which is current. So no source of fund, is not a source of fund. Okay. Issue of shares, again the purchase of fixed assets. So we issued share and we get fixed assets. So no change in current assets, again it is fixed assets, so no current assets, so no, it is not a source of fund. Okay, here funds means working capital, right? Conversion of debentures into shares. We converted debenture into shares, no change in current assets, current liabilities. Conversion of loan into shares, this is a change in non-current liabilities only, no change in current assets, current liabilities. So none of this is a source of fund, and the right answer is D, none of the above. All answers are given here. I hope you find it amazing to learn this new topic. If you find any doubts, you can directly contact me, and you will also get this PPT. So it will, I guess it will help you a lot. So we are closing for today, and meet you in the next lecture. Be happy, be safe. Goodbye.